Welcome to the Private Practice Survival Guide podcast with your host, Brandon Seigel. I'm a published author, speaker, entrepreneur, and private practice strategist dedicated to transforming the way that healthcare functions. This podcast is all about empowering you to create the change you want to see. Let's dive in. Welcome back to the Private Practice Survival Guide podcast. In this episode, we're tapping into the finance. I'm talking to you about the weekly cash flow dashboard you need to build today. That's right. You can be profitable on paper and still not make payroll. Cash flow is the lifeline. Let's track it. And it's so interesting. Recently I was working with this client and we had just started working with them. And we were working with them as a medical billing. And I was also coaching them. We were basically their fractional finance. And it's so interesting because we had just brought in more money in 1 month than they had had in 3 months. Okay. Cash flow was high. And the first thing she said to me, this practitioner, she said, Brandon, I don't know how I'm going to make payroll. I said, what are you talking about? We just 3x'd your income cash flow wise. She said, well, I already spent that money. I said, why? She's like, oh, I was paying out all this bad debt and all this stuff. I said, you've not been managing your cash flow right. She's like, you're right. Don't dig holes that you can't get out of. Some of you are taking on debt that cannot be overcome. You must understand cash flow and business algorithm and make smart decisions. The biggest mistake you can make is grow too fast. When you grow too fast, you are not systematic in how you manage your expenses. So, again, you can be profitable on paper and still not make payroll. And I say this because remember the accrual basis versus cash basis. A cash basis is cash in and you're like, well, Brandon, I just delivered, a $500,000 of services last week. And then I say to you, okay, have you collected it yet? And you're like, no. And I'm like, so you haven't. You've delivered the value that you perceive to be. So recognizing the value of a service and the cash that is received are two different things. And sometimes we have expenses that come before. So you're like, hey, Brandon, I'm going to make a 50% margin when I get paid on this work comp. And I'm like, yeah, but it took you 1.5 years to get paid on it. So how much did floating that expense cost you? Did you actually make money? Well, I never thought of it that way. So strategy number 1. Implement the Friday 15 ritual. Every Friday at 3 p.m., spend 15 minutes reviewing your weekly cash position, your outstanding AR, and upcoming payables. I want to say that one more time. The Friday 15, okay? Spend 15 minutes reviewing your weekly cash position, your outstanding AR, and your upcoming payables. Now, I want to make sure you're doing something right on a billing side. I am so exhausted seeing those that are taking insurance, not collecting copays, co-insurance, and deductibles, either at the time of visit or within 24 hours of service delivery. There is no reason for you to wait for an explanation of benefits to get paid. If you are waiting for an explanation of benefits to get paid, you are failing at cash flow. You are missing the mark, and this can be easily remedied. So when we look at our 15 minutes on Friday, look at every cash flow that came in, look at every expense, and look at where that discrepancy is. So a lot of you have heard I keep extra cash on hand. I am a cash hoarder when it comes to payroll and different things like that. But that doesn't surmount the analysis I do to say, hey, at this payroll, how much money actually came in? Am I making this payroll on a cash basis? And so I want you to think of a bucket. And in that bucket, I want you to put a hole, and the hole is your expense. And every time money comes into the bucket, I want you to measure how much is left over on a weekly basis from what has fallen out of that bucket. And look at the trends. Hey, week 1, we're up. Week 2, we're up. But week 3, every week 3, the whole bucket empties. We have to figure out why and what's evaluating that timing. And is it a weekly, daily, monthly, quarterly, annual? When does that happen? So think of it like on a personal basis. There are certain times a year when our bucket empties more than others. Property taxes, personal taxes, school expenses, whatever that may be. These are all things, vacation time, holidays, all those things. Start to track when that bucket empties and plan for it. Strategy 2, I want you to create a rolling 13-week cash flow forecast. Rolling 13-week cash flow forecast. I want you to plot your expected cash in and out weekly and identify the valleys before they become crises. And I kind of just talked about this with that analogy, the bucket, the hole in the bucket. So when we're looking at 13 weeks, we're approximately at, a quarter. And so that quarterly analysis is really critical. For those who have worked with me through growth groups and different things, you know this. I've got a quarterly analytics tracking. We are measuring your cash flow. We are measuring your accrual basis, and we're even measuring performance by employee. In that tracker, we're looking at a 13-week study often. So that is strategy 2. And strategy 3, I want you to set up 3 business bank accounts. Are you ready for this? Operations, taxes, and profit. So when you hear that I'm holding my reserves are in my profit. When I have to pay out of that profit, I document it, but usually I've already have my bucket for taxes. So you want to automatically transfer percentages to each on every deposit using your profit first principle. So 3 bank accounts, again, operations, taxes, profit. The mistake that we often make is that we spend our profit. And we only do owner's draws when our CPA tells us to. And what I've found is that profit bucket helps make us feel secure. And whatever you want that reserve account to be, that's your profit. Okay? Whatever you want you got to plan for your taxes. And sometimes what we'll do is we'll loan ourselves from profit to operations when we are growing, when we're bringing on new employees, et cetera. And so call to action for you this Friday at 3 p.m. Open your bank account. Spend 15 minutes with your numbers. That's your Friday 15. Start this week. And I know you're like, Friday, Brandon, it's right before the weekend. Friday is the time when you should be measuring everything that occurred this week and making the decision on what you're going to do differently next week. So when I look at cash flow, I want to measure what cash flow is based on real time and what cash flow is based on past due balances. So co-insurance, co-pay, deductibles, that's real-time money owed. Insurance payments are accrual payments that you're receiving after the fact. When you have retractions and whatnot, you need to measure your percentage of retractions for cash flow planning. So year over year, typically we're seeing 3% of income gets retracted in the field of insurance. I've seen worse, and sometimes we can fight it, but if you plan for a 97% clean collection rate, it will help you budget. The mistake that many of you are making is that you're building business algorithms based on 100% guaranteed collection rate. And in insurance, we don't operate with 100% collection rate. It's very rare. It's a unique business outlier. So we're budgeting our expenses to operate on 100%. And I always say, Under promise, over deliver. So if I were to say, I'm going to build a business algorithm on a 90% collection rate, and I'm going to expect a 97%, I'm building in 7% extra margin in that approach. Cash flow is crucial. You need to look at how you're measuring cash in versus cash out. What are the expenses that are pulling from that? How do we run a 30-day, again, with insurance? Now, I'm not saying you can't hit 90% collections or 97% collections in 30 days, but it depends on your payer contract. Some payers will take longer. It also depends if you're doing a primary and a secondary and a tertiary, recognizing that with every additional payer on a patient's payer list, your cash flow gets delayed. So if I have 3 different payers, to get paid on that visit is going to take, in my opinion, 3 times longer than if I had 1 payer. That has to be part of our business algorithm. Sometimes we limit how many payers we take so that we can prevent having a duplicate tertiary or secondary payer mix that just destroys our company. These are all things we want to measure. So I always say I'd rather take less margin and get paid faster. So if you're willing to take, let's call it $100 an hour from insurance, and it takes them on average, let's just say 30 days to get paid, why wouldn't I take $90 to get paid at the time of visit? Cash is king and queen. It rules the roost. And so I leave you with this notion. Revenue is vanity. Profit is sanity. But cash flow is reality. Thank you for tuning into this episode of the Private Practice Survival Guide podcast. Don't forget to like us, subscribe, write a review, and share us with any business owner you know that wants to change the way their private practice functions, because together we can thrive, not just survive. Thank you for tuning in to the Private Practice Survival Guide podcast. I'm incredibly grateful to each and every one of you. Exciting news. We're now available everywhere, from Spotify to Apple Podcasts to YouTube or anywhere you like to listen to your podcasts. So watch, listen, and reach out. If you loved this episode, please drop a 5-star review. It truly means the world to me. Are you looking for more ways to elevate your practice? If so, now is your chance. Reach out, go to my website, or email me at brandon@wellnessworksmp.com. And remember, it's not just about surviving, it's about thriving.